Welcome to the Daily Update. This is being prepared Friday, May 6th, where we'll look at the action in the market today and then see how things look for Monday, May 9th. Another negative day. It wasn't as aggressive as what we saw on Thursday, but still some technical damage was done. We're even looking at being short-term oversold according to some of our indicators, but we're still negative overall, although there are some positive things that we can look at. Before I get started, just know that you can access all of the slides that I use in these videos at spxinvestingblog.com. The slides that I use as part of the video are saved as a PDF so that you can download that, you can save them individually. I also upload all of the other charts that I look at but don't use in the video. But those aren't available as a PDF currently right now. So let's go back and talk about what happened on Friday. At the open, we had a large gap, lower open. Things were pretty negative. Even though the employment report came out and it was considered to be pretty friendly and it didn't show anything real major, it showed growth, but it had more of a negative impact on the open because of the growth that has been seen. We ended up going below S1, which was at about 40.78. And then as the day went on, we tried to rebound. We got back up to the unchanged level, even went positive a little bit. Prices bounced, but never were able to break through that unchanged level. We would come up to it, drop back, go back up to it, drop back. Prices then ended up drifting lower. And going into the close, we saw some late day buying that helped us to close off of the low. We were down 0.57%. Volume was above average, and the technicals are pretty much negative, as I said, but short-term oversold, at least with some indicators. Inflation and interest rates seem to be the real fixation right now. Of course, all the different geopolitical concerns, and then earnings as they're coming out. Some are being positive, some are negative, some don't really have an influence at all. So what are some comments that we can make? Of course, the selling continued. That drove prices lower. Rising interest rates are negatively impacting stocks. We did hold up that long-term support. We went back down to that level, and that's becoming more critical now. But so far, we've been able to bounce up off of that. We are becoming short-term oversold. Heating oil is really rising, and gas is really rising, as well as diesel. And I'll have another chart to show you there. The S&P continues to be in correction territory. The economic reports that came out, we had the big jobs number, or the employment situation report. It showed that we increased the number of jobs by 428,000. They expected 395,000, so this was stronger than expected. That added a little bit to the negative overtone that we were seeing. As far as our trend, it is negative and kind of weakening right now. It's kind of going sideways, but it's above 20, so we still have a negative trend. The bias is negative, and the momentum continues to be negative. So far, the Nasdaq, it's now down, at least on a year-to-date basis, into bear market territory. The Russell's not far behind, down 18.1%. Those are the small caps. The S&P is down 13.5%, which is different than what I measure, because I'm going from the all-time high. This is just starting from the beginning of the year, which was a few days before that. And the Dow is down 9.5% year to date. Let's go back and talk about the day's session. We had pretty much across the board, all of our indexes, except for the utilities, they were up. But it wasn't as aggressive as what we've seen, but it was still negative. Some other major markets, France had a bad day, Europe had a bad day, Germany had a bad day. It's pretty much negative, specifically between Europe and America right now. As far as sentiment, we're still tipping down to the lower end of the not really fearful category. We want to get down to extreme fear where we could see more of a bounce potential based on sentiment. But we're not quite seeing that yet, and here's the longer-term chart. We want to see this be able to drop below 25. We did have the AAII summary that came out later in the week, and even though it improved, after being really, really negative, it's still very negative. So this could be a good contrary indicator. You have a lot of individual investors right now who are very fearful about things. And as I usually say, we, meaning individual investors, tend to react instead of proact. And they see everything going on and then they react to that. So when this gets really extreme, we often use that in a contrary manner. If everybody is thinking we're going down, that might be about the time when it looks that we're going to go up. Another indication is that we saw the bear-bull ratio from Ridex spike up. It's been higher than this before, but it was at 0.10 in this past week. So they're seeing a lot of fear increasing that way. We also saw the asset managers who are actively managing their funds, whether it's a mutual fund or a hedge fund, they actually increased their exposure slightly over the last week, and I tried to include more on this chart. They're not necessarily extreme negative, they're not extreme positive, but they were willing to jump back in over the last week. The VIX, it actually declined a little bit on a closing basis. It really spiked up as we were going lower, but then dropped and closed near the bottom for the session. So we ended up decreasing a bit that way. The VIX of the VIX, it also spiked up and then came back down a little bit on a closing basis. So a lot of the fear was seen earlier in the day. And then we saw a bit of a bounce near the end of the session, and that helped to subside fear slightly. The Ulcer Index, which also measures fear, continues to show an increase, and we're starting to get pretty high with this reading, at least going back the few years that this chart goes. Other times when we've had this level of fear in the Ulcer Index, that sometimes has marked the bottom. The equity put-call ratio on a one-day basis did increase, so you have people that are hedging. Then looking at this over a 5-period simple moving average, it shows that we are decreasing overall. As far as inflation, we saw a bit of a decline in the CRB, but it continues to be in a pretty strong uptrend. Gas, this is what I mentioned earlier. It's really starting to spike up again, and you're probably seeing that at the pump. Heating oil, it's not as high as it was before, but it has been going up. I also wanted to bring up corn because it's starting to break out. Even though it was down a bit on Friday, it's been getting a little toppy and more expensive. And that's used heavily throughout the economy, which could feed more into inflation, as well as wheat. Not as high as it's been before, but it's still in a pretty strong uptrend. The sectors, most of them were not doing very well. Even the one that was up, energy, that was up, well, almost 3%. That was a pretty good, healthy move. But negative, communication, materials, discretionary, real estate, they were down anywhere from 1% to 2%. Most of them were kind of down or up slightly, but less than 1% either way. Then looking at our sector since the all-time high, energy is doing very well. Utilities are still up. Over on the right-hand side, discretionary, communication, and technology. And then financials are starting to have some problems as well. The different blog charts that we have, this just shows the cumulative fund flows across different assets. The black line is equity, that's stocks. We're seeing it go up, but it's been tapering off so far. You can see it going down just slightly. We have a lot of people going into corporate bonds because they are giving a higher yield than the government bonds are. With the orange line, we are seeing kind of a leveling off of going into government bonds, and we're seeing a decrease in money markets. This is the Fed balance sheet. As of the latest period, it shows it kind of topping out. It should start to go down here pretty soon as the Fed begins their tapering plan. Since the Fed is the one that's getting rid of these things, and this is their projected forecast that they think it will happen, the idea is that bond prices will actually become more valuable because there are fewer and fewer bonds out there. And if bond prices go up, that will decrease the interest rate on that bond. At least that's the hope. Then we have this first quarter, the S&P blended earnings per share year over year. they're saying, and I didn't draw this red arrow, but they're just showing how the earnings per share has really climbed, but now it's starting to drop down. So is this something we need to be concerned about? It has been going up, but lately it's been going down. Then this also shows 4 or more consecutive negative months with the prices within the S&P 500, and we're in one of those right now. We're having a really difficult time, and this goes all the way back to 1900. This also shows the different valuation levels, and this deals more with some of the videos that I do based on the PE ratio. Typically what you'll want to have when you look at valuation levels is 10 or lower is considered cheap, 15 is just about right, and then when you get to 20 or over, that is considered expensive. So looking at the Canadian market, they are more in the cheap category right now, or to just about right, where the S&P, it's dropping down and is also not considered overvalued, at least according to this chart. Now, I have other charts that show something different. And then on the top with the Nasdaq, it's still showing that we're well above the 20 level. And this is based on looking forward, and that they always try to paint a rosier picture. That's why some of the charts that I have look different, because I look back. Now, the stock market looks forward, and that's what they're basing things on, where I like to go back and look at things that are more concrete to get a valuation level. And then I use a combination of the two together. As far as our technical alerts, most of them were negative. We had the Nasdaq dropping below 12.3, then 12.2, then 12.1. The S&P went below 4,100 and actually closed at that level. The Dow was able to get back above 3,300. The dollar is now setting a new 4-year high. So intraday, we did gap lower, and we went all the way down to S1 and even broke a little bit below that. Then we bounced back up off of that and looked like, okay, maybe we're getting some kind of a recovery underway here. We got back up to the unchanged level, which in this case acted as resistance. We bounced down back from that, tried to go up to the unchanged level again. That still wasn't happening. So we saw more selling as the day went on. Then late in the day, we saw some buying coming in that took us well off of the lows. So we could have been down a lot more than what we were. This is the long-term support that I'm talking about, that LT support line. We were able to stay above that. That matches back to a previous low. Can this hold? We've already tested it twice now, and you could say so far that was a successful test. Can we get some momentum going up off of that long-term support level? That's the question now. And then way down at the bottom, it shows where the volume was above average on Friday. We're down 14.04% from the all-time high. Technical overview, not a lot of changes here. The things that are positive are energy, commodities, gold, interest rates, because they're going up, and staples, the things that you have to have. Those things that are negative, not really a lot of changes here. The Dow Jones Composite, which takes the Dow, the trannies, and the utilities and puts them together. The world indexes, again, we're seeing more negativity worldwide right now. Junk bonds, the FANG index, small caps, the Dow, mid caps, Nasdaq 100, NYSE, the all stocks, not only U.S. stocks, but world stocks. ARK is really having some trouble these days. Bitcoin has also been kind of weak lately, but not really moving all that much. It's into the about the mid 30s, maybe even the upper 30s now. The Wilshire world indexes that we look at, Treasury and corporate bond prices, not interest rates, but prices. The positive setups, Coptic curve, not happening. Mass index, not happening. Pring bottom fisher, not happening. The small cap thrust, not happening. The positive backdrop after an inverted yield curve, we're not inverted anymore. We're not seeing anything yet. Could there be a scenario that we bounce up off of that long-term support and then start to see some strength from here? The staples, it's looking a little bit better than it was after Thursday's session, but we still don't really know if the staples ratio has spiked yet, and I'll have a chart to show you. As far as our trend, we are above 20. We're kind of going flat. The red line is on top, which shows that we are in a negative trend and buying power is really decreasing. The Arun is showing that sellers are in control, but that's coming down a little bit. Buyers have flattened out, and our oscillator actually turned up slightly. Breadth, I haven't showed this chart for a while. It shows that we are slightly negative based on price because we're below the moving average. We're quite a bit more negative based on volume. Here's a chart that I haven't shown before. This is the 10-day average of S&P 500 highs and lows. And it just shows that we're getting pretty low. We're at 14.97 right now. Sometimes that has been an extreme reading, although this can go lower than what we're seeing right now. This is the new highs and new lows on the S&P more on a daily basis, which just shows we're kind of getting more extreme negative, even though we could go lower than this. But this is just adding more to the idea that short term we could be oversold in the S&P. Intermediate term, the rate of change is extreme negative. That's a little longer term. The Sean trend meter, extreme negative. Our STO is actually turned up a little bit. And this has been pretty clever lately. This indicator has actually been leading us a little bit. We'll see if that still continues. Based on price, it's above zero and advanced, the blue line. Green also is above zero and advanced. The CCI, it's getting extreme negative on the 14 period as well as on the 20 period. The Chaikin oscillator, it's actually above the dash line, which means it's more positive and advancing. And I don't have an annotation on here. This is the slope momentum indicator because I have a list of all of our different momentum oscillators that we look at, and the slope is the only one that's looking a little bit positive. It looked like it was going to cross over a day or two ago after we had the big upthrust. Well, now it's been flattening out, but it still hasn't gone back real strong negative yet. Williams percent R is starting to get extreme negative. And then our Fibonacci levels, we broke down below the 61.8. Well, we're trying to come back up to that level now, but that could be acting as overhead resistance. The stochastics are extreme on the short term. They're turning down intermediate term, and they never did go positive in the long term, and they're starting to roll over again, giving us an extreme negative reading. Our trading systems, the S&P is negative, SPY is negative. Our different charts, Heiken Ashi, haven't shown this in a while, looking more negative, as is the three-line break. No new signal on the point and figure chart, but we did have a new zero that was drawn in, so that's more negative, but it's not picking up any kind of a signal right now. Long term, we're below the 200-day moving average. The rate of change going back 250 periods, we're just dropping below zero. We're at 0.69%. And here's a longer term view of that chart. Our moving average study based on longer moving averages show that our 50 period, we're getting extreme negative where we're declining on the 150 and 200. The special K continues to decline. That's a longer term trend measurement. Broad market, the Vixen, it actually decreased as well on the bar chart. It closed well off the high, but it increased on a closing basis. And this is based on the Nasdaq 100. The diamonds are negative. The Qs are negative. Here's a look at all the different world indexes. China's trying to bounce back up, and Europe is trying to bounce back up, but they've been seeing some recent weakness as well. Japan is negative, and the US continues to be negative. Broad market, intermarket analysis. Oil doing the best. The dollar's still been holding up and doing quite well. Gold has not been performing all that well. The S&P is down, and bond prices have been down. The dollar, it was down a little bit, but still is pretty strong. It's at 103.69 right now. Oil settled at 109.77. It was up on Friday. Here's diesel, which it's kind of hard to see, but that's going up way over on the right-hand side. As far as bond prices, they continue to fall, and we're seeing a real breakdown in bond prices right now. The yields continue to advance. The shorter maturity of the 3-month, it was pretty much flat, but we saw an increase in interest rates otherwise. Here's a look at all the different world rates based on their 10-year bonds. And again, as I keep pointing out, what we're really watching is the red line, which is Japan. Here is the yen, how it's been declining. The euro's been declining as the dollar has been advancing. Our different scenarios, they're just not happening. The Kopit curve continues to fall. We're waiting for that to roll over and go back up. Mass index, it is above the dash line, but it needs to get above the blue line for the first part of the signal to be generated. The PRING continues to go further down. 2-year Treasury yield, it doesn't necessarily show that we're spiking yet. It was up again on Friday. And then this is the staple spike ratio, where it's a little bit hard to see, but we're back slightly above the moving average right now. So this is looking a little bit more viable. The small cap to S&P 500 ratio, we're not getting anything from that. Small caps have been quite weak. We're not seeing that little thrust up that can happen 1 or 2 or 3 or 4 days before we see a thrust up in the S&P itself, and that's just not happening. So what's our outlook then for Monday? The technicals are negative and becoming oversold. Shorter term, we're a little bit more oversold, but there are some indicators that are not necessarily oversold yet. The markets are still in this range that we've been in for 2022. Growth and value seem to go back and forth. Economic reports, there are wholesale inventories that'll be coming out on Monday. The geopolitical events, Russia, Ukraine. Be careful about what's coming out. My understanding is May 9th is a very important day in Russia and Eastern European history. That's their victory day when World War II ended for them. It's a day that we don't really even recognize in the U.S. because we had 2 ends to World War II, not only in Europe, but also in Japan. But it's a very, very important day. And some people that I kind of pay attention to, they're hearing rumblings that something might happen on Monday. I hope that's just an erroneous rumor, but we still have to be prepared for that nonetheless. China is still locking down pretty heavily. That has an influence on the supply chain. Then we have to deal with inflation and interest rates. That's what the markets are really fixated on. Oil, even though it's high, is not freaking everybody out currently. Earnings report are just day by day. Haven't really heard anything from the Fed folks for a while. And then we're watching the situation in Japan with their demographics and especially in their bond market right now. So our scenarios, we are down. And what's causing this? If we see interest rates continue to go up or things that come out that point to inflation, that could send prices lower. Earnings, and then any Fed speak can be negative for the market. The technicals are negative and becoming oversold. What could make us go up from here? We have these possible positive scenarios that really, other than the Staples spike, none of them are really coming together at this point. The technicals, we are bouncing up off of that long-term support. Could that be something? Sideways, we're not in a sideways market now because we're above 20, and it's declining to flat a little bit, but we're still showing that we're in a negative trend with the ADX. So our conclusion is the S&P is negative, short term, negative and becoming oversold. Intermediate term, just more negative. Everything is negative right now with the S&P, other than some support or the fact that we get oversold. Long term, we're negative because we are below the 200-day simple moving average. So thank you very much. Have a great weekend, and I will anticipate posting the weekly video sometime on Sunday.